Great. All right. Hello, everyone. Happy Thursday. I can't believe we are in March and daylight savings is approaching. We're just talking about how much we need the sun. Jackie and I were also just talking about how tax season and all the tax questions can be super anxiety bringing and super nerve wracking. So I'm so thankful that Jackie Roessler is here with us to share more. I'm going to introduce her in a second. First, I just would like to say hi. I'm Allison Terrell. I'm with Phoenix Financial Advocates, and it is so important for us to be able to help people navigate the financial aspects through divorce. I had no idea that divorce could be a full-time job. I also did not know how much I needed to know about my finances to make sure that I was taken care of in my next life. So anywhere, if you're, you know, contemplating divorce, or you're in the middle of divorce, or you're just getting through a divorce, we can help in a variety of ways. Before divorce, we can give projections, we can strategize what kind of support you might need, we can help you with your affidavits, we can figure out how much your life costs. During divorce, we can help you find hidden assets if that is a situation you might have. We can testify for you in court. We can help you figure out if you can keep the house. We can even, we also provide business valuations at a fraction of the typical cost, which if you have a personal business is necessary to make sure that it's divided up equally. And then after the fact, we can also help you with lowering your household bills, negotiating your debt, helping you rebuild your credit, and even negotiating medical bills, a lot of different ways, budget counseling, things like that. We are here to help instead of Google. That's where everyone tends to go, but we are here to hold your hand in a little bit more of a helpful way, I hope. And then also, if you are navigating the process and are looking for a solution, a smarter solution to divorce, we do have an awesome out-of-court option for you. It's called Soul Agree, and that's a combination of two very old concepts, mediation and arbitration, put together in a way to help you get across the finish line with a flat fee that is also virtual, and it's expedited, so it can help you move along the process, because the longer this takes, unfortunately, the more resentment builds, the more voices get involved, and we are hoping to just help you save in every way and lower the financial and emotional cost of divorce. So thank you for joining for another one of our webinars. We try to offer a few of these a month to educate and empower you along the way. I am honored to have friends like Jackie Roessler, who is a helper out there who steps in and helps people navigate all of the difficult processes. I'm going to let her share with you a little bit more about who she is and her background, and then she can take it away. So thank you, Jackie.
Allison, I'm so excited to be here, and I really appreciate the opportunity to give information to people that you work with at Phoenix Financial Advocates, and the services that you offer, as you just went through, are pretty amazing. So actually, I'm going to share my screen. Let's see. So today, so I'm a certified divorce financial analyst, which I have been for almost 30 years, which makes me feel really old to say that, but I've been practicing CDFA now for 30 years. I'm in Michigan, although I do work with clients throughout the country, but primarily in Michigan. And I am also a podcast host, and I am a retirement account division expert, which, so I have additional training and experience in dividing up retirement accounts pursuant to divorce. My practice, again, is based in Michigan, but I do work with clients all over the country. Today, we're going to be talking about one of my favorite topics, which makes me sound like the complete dork that I am. But today, we're going to be talking about tax literacy and why it matters. So I have a confession to make. As I was thinking about what to present, because there's so much information on taxes that I can cover, I sat down and thought about the clients that I worked with in 2024 and what they needed to hear in terms of tax advice. And I recognized that whether or not they were the high income earner, or they were the low wage earner, or a stay-at-home parent, everyone seemed to be in the same situation as far as understanding tax concepts and issues. So I went online and I did a little research, and I found that there were several studies recently that have been done gauging Americans' tax literacy, how much information they know about about taxes. And I was really shocked at the results. And I was sharing this with Allison. Higher educational levels are usually associated with better performance on tax knowledge questions. But regardless of educational attainment, more than half of the people that responded to a 2024 nonprofit survey had no tax proficiency whatsoever. In fact, only 2% of the respondents in this survey exhibited what we would call proficient tax knowledge. So why does it matter? Why can't we just bury our heads in the sand and think about our taxes when tax time comes, as we're approaching it now? The reason why it matters is that all Americans, regardless of whether or not they're getting a divorce or have been divorced, need to understand basic tax concepts and rules so that you can make sound financial decisions for yourself. It really does matter. And it's critical to understand the tax laws related to divorce when you're getting divorced, or if you've been recently divorced, even in the last few years, because some small changes, there are some certain tax laws that you can only take advantage of during and after divorce. And some small changes in negotiation can have a really huge impact on what your net income is, what you take home as your paycheck, going forward. So it's really important that we have tax literacy. So my goal today is to provide you with some basic divorce tax literacy so that you can be your own advocate. Now, does that mean that you shouldn't work with a professional? You shouldn't work with a financial advisor? You shouldn't work with a lawyer or a tax specialist? Absolutely not. You still should involve that, especially if you have some complicated issues that are tax related in your case. However, your own tax literacy will make you a better advocate for yourself because you'll be able to understand the questions you're asking. And a lot of times your attorney doesn't understand the tax issues either. And so it's really important. Again, this is an area where you can really make a difference in the outcome of your case. So I'm going to start at the beginning. And for all of you that are thinking, oh no, I'm not good at numbers, I don't like to see tax numbers. I don't let any of my clients say that they're not good at numbers. It's different to not be educated and informed to say you're not good at it. And this is something that everybody can learn. So let's talk about tax brackets. So just some basic information first. So ignore the right side of the screen. If you were married on December 31st of 2024, you have to file married and joint or married and separate. That decision has already been made for you. Your tax status is determined for the entire year based on what your status is on December 31st. If you were divorced anytime prior to and including December 31st, you have to file single or head of household. You cannot file joint. So that's confusing to a lot of people. Even if you were divorced on December 15th, it doesn't matter. The IRS sees you as being divorced for the entire year, and that's how you're going to file. Now, whether or not you file as single or head of household, I'm going to touch on that and why it makes a difference for you to know that the differences between that and why you might want to advocate for yourself when it comes to that. One thing that you should know, child support, if you're receiving it, is not reported as taxable income. It's not treated as taxable income to you. And if you're the one paying it, you don't get a deduction for child support. Alimony is generally not reported as taxable income either. So I said, I've been doing this for a really long time. My entire career, alimony was always treated as taxable income to the recipient until recently. If your divorce was final on January 1st, 2019 or after, you are no longer responsible to claim that alimony that you're receiving as taxable income. I'm in Michigan, we call it spousal support. Some states call it spousal maintenance. It's all the same, it's all alimony. And if you were divorced if your divorce was final after January 1st, 2019, you do not claim that as taxable income. So this is a good time too, as we're talking about this. If you were divorced in 2024 and you're getting set to file your taxes, now is a great time for you to unlock that drawer where you're through the divorce decree that you probably never wanted to see again. Now is a really good time to take it out and read it and read through the sections that talk about how you're going to claim your children and who gets to file as what for the tax year. It's really important that you do that. And again, remember, alimony isn't taxable, neither is child support. So now let's take a look at the right-hand side of this pyramid. So what you see here are the tax brackets for 2024. Let's go to the very bottom. If your earned income, and you're filing single this year, if your earned income is up to $11,600, you are in the 10% federal tax bracket. Now, if you look over to the right, I'm comparing this with what your tax bracket would be if you're married. If you look over to the right, you can see that up to $23,200 of taxable income still puts you in the 10% bracket if you're married. So of course, the goal is to pay the least amount in taxes. So the more income you make, the higher you're taxed. I want to explain also that we are in a blended tax bracket. So let's say that my client's income is $55,000. So I'm going to look at this chart. My client is filing single. That puts them in that 22% bracket. That does not mean that all of their income is taxed at 22%. The first $11,600 is taxed at 10%. The next dollar over, up to $47,150, is taxed at 12%. And then the next dollar over $47,150 is taxed at 22%. So I know this sounds a little confusing. The big takeaway here is that we are in a blended tax bracket. So even if you have money that earned income that pushes you into the next tax bracket, just that small portion that's pushing you into it is going to be taxed at that highest rate. So that's really important to remember. For most people, unless you're in a very low bracket or a very high bracket, most people average into about a 25% effective federal tax bracket. And that's when we merge all of those together. So let's say that you got divorced in 2024 and your income, you've got child support, and I've got a slide on this. So let's take Kristen. Kristen was divorced March 1st, 2024. So she is going to be filing single or head of household, which we'll talk about in a minute. So right now we're looking at the left-hand side of this pyramid. Her income this year is going to include $24,000 in child support, $12,000 in spousal support or alimony, and $10,000 from her part-time job at her kid's school. She's going to file as single. So what would her tax bracket be? So I'll give you a few seconds to think about it, but the tax bracket, so $24,000 doesn't count in child support. $12,000 doesn't count in spousal support. She's earned $10,000 from her part-time job at her kid's school. So we're going to assume she's in the 10%, the lowest bracket. Now, what I'm not going to cover today are itemized deductions, which krreduce your taxable income down. It's a little bit more than I wanted to get into. I just want to get across these basic ideas. So for Kristen, for Kristen, I was going to insert you into my example. For Kristen, we can see that she's in a really low tax bracket this year. And so that provides lots of opportunities, which we're going to talk about. What would she owe in federal taxes would be just 10% of whatever is considered to be 10% of her earned income that's reportable. Now, here's a negotiation point in a divorce. This is a really important topic. I work with, I think, some really brilliant attorneys in Michigan. I am tired of talking about this issue. I feel like even the most brilliant attorneys that I work with don't understand why this matters about the head of household rules in divorce. And this is, again, where it's a negotiation point in a divorce. And if you haven't been divorced yet, and you're in the process of divorce for 2025, this is something that I want you to take out and remember to have this conversation with your attorney if you have minor children. So the IRS says whoever gets to claim head of household, which is a better tax bracket than single, and I'm going to show you that diagram in a minute, but whoever gets to claim head of household has to be the custodial parent of a child 17 and under, and they have to claim that child as a dependent. The IRS's definition, which is the only one that matters, of a custodial parent is the parent that has greater than 50% of the overnights with that child. So let's have that sink in. So for those of you, if you're looking back at your judgment of divorce, what I find most often in Michigan and the cases that I work on, and I work with about 40 to 50 clients a year. And again, I've been doing this for 30 years, so it's a long time, and a lot of clients. Most often what I see is something that says if there are minor children that the parties, the husband and wife, will split the tax, they call it the tax dependency exemption, and they both get to claim head of household. So just to clarify, the tax dependency exemption amount right now in our current tax code is 0. There's no benefit to the tax dependency exemption. There used to be, and there might be again. We're taping this in 2024, and this certainly could change. But right now, there's no financial benefit to the dependency exemptions. But what there is a financial benefit to is being able to claim head of household. And there are other things that go along with that are beneficial to not only in a reduced tax bracket, but in other benefits, such as the child credit. So for every qualifying child, if you are able to claim the child credit, you get a credit back of $2,000 per child. This is a non-refundable credit. This is unheard of in our tax code, really. So it's not a deduction off of your income. You actually get that money back, even if you don't have any earned income. So even if you only had child support and spousal support and you were claiming head of household for a minor child, you would get that credit of $2,000. Why would anybody want to walk away from that? Here's the catch. It is phased out at $200,000 of income if you're filing as head of household or a single taxpayer. That means if you're getting divorced and there is an income discrepancy between you and your former spouse, if their income is higher than $200,000, it is a very minimal benefit to them to claim head of household. So this is why it's a negotiation point in a divorce. When you have a very high wage earner, let's say that your spouse, and I know this doesn't apply to everyone, but let's say your spouse makes over $200,000. It will be better for you to claim the dependency exemption, which goes along with who gets to claim head of household and who gets the child credit. Let's say you have 3 minor children. What's the point of splitting the dependency exemptions if your former spouse isn't going to get to use it? So if they don't get to use it, when you're negotiating, you want to try and think of some financial win-wins. This is one of them. This is one of those places where you can say, how about if I get that exemption? How about if I get to claim all 3 of the kids, which just means that in my divorce decree, the language needs to say that I have 183 overnights. Again, I'm not a lawyer. I cannot give you legal advice. I can give you legal information based on my experience. This is something that you're going to want to have a conversation with your attorney about. I just find that for most cases, at the very end of the divorce, when everything is done and finalized, the standard language is we're going to split the dependency exemptions. And nobody ever asked the question, does that even matter? And wouldn't it be better to give up something else in order to get them for the person that can actually get that credit? So here we have Kristen again, tax brackets for 2024. Now I'm comparing on the left single to head of household. And what we can see at the bottom here is that if we go back to that 10% bracket at the very bottom, that now if Kristen is head of household, up to $16,550 of her income gets taxed just at 10%. So that's a big boost. And where we really see it is in this next bracket up at the 12% bracket. We've now increased the 12% bracket, the high end. If you're single, you can only claim $47,150 at 12%, and that's on the left-hand side, bottom, right next to that number 12. If you look to the right of that, it goes all the way up to $63,000 if you're head of household. Well, that makes a big difference for somebody who is getting back into the workforce, transitioning in. They would probably really rather claim head of household. But I want you to take a look also up here because I want you to have this knowledge to take back to your attorney. I want you to look up at the bracket over 200,000. Over 200,000, the 32% bracket, the 35% bracket, and the 37% bracket are the same for single or head of household. So there, again, we're kind of eliminating the argument that, well, the higher wage earner should be able to claim head of household too. One, they're not going to get the child credit if their income is over 200,000. Two, the head of household status is not going to benefit them in any way. So again, these are conversations that you want to have with your attorney, even if you are tired of negotiating and the case is done and you just want to be done. I can't tell you how many times I have heard clients say, I just want to be done. And I completely get that. But when the settlement is done and you're about to put everything in writing and finalize it, that is not the time to take your foot off the gas. That is the time for you to dig in and start to think about these small things that are going to have a potentially big impact for you down the line. So you can see here that Kristen now in this example, she's making $25,000 in earned income. If she files it as head of household, she's in that 12% bracket. And again, I explained that blended rate. So now you know more than 98% of the Americans that were polled in this nonprofit poll that I was telling you about before. Let's talk about some things that are specifically relevant to divorce. So this comes up in every case that I have. Clients want to know, if I get an asset that was owned by my spouse, is that a taxable event for me? Any property transferred pursuant to divorce based on the IRS code, so based on federal law, is a non-taxable event. However, the transfer should take place within 1 year from the date of divorce, or it should be pursuant to a written decree and take place within 6 years from the date of divorce. Now, that is a surprise to some people. I have clients that didn't get their quadros drafted until 20 years after the divorce was done, which, by the way, I would never, ever recommend. And I'm going to talk a little bit about what quadros are, but that's a very dangerous thing to do, to let it go that long. But obviously, you want to try and get these transfers done, no matter what kind of transfer they are, whether it's a brokerage account, a cash account, the title on your house. Everything should be done really within the first year of the divorce for your own protection, because the longer it goes on, the longer there is an opportunity for your spouse to do something with that asset that you're supposed to get that could make it more difficult for you to get that asset. And you have to keep in mind, your divorce decree is only binding on you and your former spouse. It is not binding on third parties. So if your divorce decree says that you get your spouse's IRA and then they cash it in before you get around to filling out that paperwork, you're out of luck. You're going to have to go back to court to try to get that asset, because the IRA custodian is going to say, that's not my problem. I didn't have anything that said I needed to transfer it. It's up to you to get those things done post-divorce. Now, is this policed very often? No, very infrequently. I've never had a case in all these years where someone said, the IRS came back and audited me and said that it took too long to transfer assets. It's just important for you to know the basic rule. But no, this is not audited very often. Another really important thing to consider is that the cost basis of any post-tax asset that you get transfers to you with that asset. And I'm going to talk a little bit more about that. So what is cost basis and why does it matter? Let's say that Matt received 100% of his ex-wife's brokerage account in exchange for her getting his share of the marital home. So she keeps the marital home. His equity was 100,000. That's his 50%. He keeps that, and she keeps that, and he gets $100,000 in a brokerage account. So that's equal, right? That's fair. Happens all the time. When I see clients trying to negotiate their own cases, they will sometimes bring me a settlement that looks something like this. So we have to be careful to always compare apples to apples when we're looking at transferring assets. The brokerage account value on the date of the divorce was $100,000. By the way, the brokerage account value is going to fluctuate based on the investments inside of it. The longer you wait to get this transferred, the longer the possibility that your $100,000 is not going to be equal to that $100,000 in equity in the home. Whether that benefits you or not depends on your situation. But let's say that we're going to go on face value and say that it's worth $100,000. Now, I had a case just like this the other day. I'm a neutral on a case. My clients, they purchased Lululemon stock 2 years ago, and it is up 75%. Their initial purchase price on this account was $25,000. That means they put $25,000 in. That's the cost basis, the amount that you put into an investment. When you sell that investment, you have to pay taxes. The IRS says, oh, you made a profit? Great, we want a little bit of that. So if you sell it, the potential capital gain is the basis subtracted from the value on the date of the sale. So in this case, 100,000 minus 25,000, there's a potential capital gain of $75,000. Does that mean that it's reduced by 75? No. Capital gain taxes are based on your tax bracket. and how long you've held that asset. But in this particular case, it's subject to capital gains. So in this case, there was $15,000 due that needs to be debited off of Matthew's asset. So he actually netted 85,000 less the 15,000 in capital gains taxes. So this is a common question from a client. If Matthew's not selling it right away, why does it matter? And the reason it matters, and again, this is going to vary by state. I'm talking to you for Michigan. And so there are some differences in certain states that I know of. For example, in Colorado, you are not allowed to take taxes into consideration on some of these transfers. But in my state, we take a snapshot of what the marital estate looks like today. And that includes reducing any tax liability, almost as if you've got a loan out or a lien against that asset. We want to compare apples to apples. So how can you advocate for yourself? Make sure that you ask for the cost basis. So you need to get an account statement for any after-tax account, a brokerage account, that a non-retirement account that shows the amount of money invested in it. And that is true for life insurance cash value policies as well. You want to know what the basis is. And if you don't get that information the first time you ask, you have to ask again. If you are going to be receiving any assets that have appreciated outside of retirement accounts, you need to have that knowledge when you take that asset. Here's another thing to keep in mind. Same thing, same situation here. Matthew, brokerage account was invested in mutual funds. Mutual funds pay out dividends and capital gains throughout the year to their shareholders. A mutual fund is basically a basket of, it can be a basket of multiple stocks. It can be a basket of multiple bonds. It can be a basket of a combination of stocks and bonds. It could be cash. It's a holding tank for a bunch of assets. Sometimes they are international. Sometimes they're sector specific. So you can get a healthcare mutual fund or a technology mutual fund. When you buy into a mutual fund, you're buying a share and you are leveraging the brain of the mutual fund manager, who is using their mind to buy and sell those stocks. So inside of that basket, if you own a mutual fund, they will often sell things throughout the year and pass it along to the investors. And it doesn't change the value of the shares. It's just a tax that goes along with owning it. That's really all you need to remember, is that if you're receiving mutual funds, and let's say in this case with Matthew, he got all the mutual fund assets. There were $15,000 of taxable dividends paid throughout the year. Now, some of the year he was married to his spouse, but because he got this asset in the divorce, all of the tax liability goes to the person that gets that asset. So now there's $3,000 in taxes due that he wasn't prepared for. Again, this is just why you need to ask a lot of questions. The main takeaway here is not that you become a tax expert. It's that you know what questions to ask. And usually that involves getting a statement. And it doesn't, so a lot of people in a divorce, if they haven't been the spouse that's been in charge of managing the finances, they maybe use an outside software company where they are an Excel spreadsheet where they tally up all the values of all the accounts. That's not good enough. You need an actual statement. The statement shows the dividends that were paid, the tax liability on those for the year, and you also will be able to see the cost basis on most statements. Okay. Coming to the second part of what I'm going to talk about, I'm going to talk for about 10 more minutes and then leave it open for about 5 minutes of questions. This comes up in a lot of cases. Do you need to free up liquid cash out of your assets? And if you do, are you evaluating the tax consequences? So liquid means that you can use that money. It's available to you without tax or penalty. So for example, a lot of my clients are looking to purchase a house or a condo, let's say, after the divorce is done. But all of their money is tied up in other assets that are not liquid. So we can't go to the bank and say, I need to get cash from my house. Just go ahead and I'll trade you some bricks. It would take some time to refinance a loan if that's where the money is coming from. If the money is coming from a retirement account, we're going to talk about what needs to be done to free that up. So anything that's not in the bank or in a money market account is considered illiquid. And a lot of people going through divorce, both of them need to free up liquid cash. So the first cash settlement option to free up cash would be through a quadro distribution. So I'm going to back up a little bit and talk about what this is. I'm sure that if you're getting divorced or you have been, you're familiar with the term quadro, which is shorthand for a qualified domestic relations order. So a qualified domestic relations order transfers money from a former spouse to their former, from your spouse to their former spouse when you get divorced. You only have to have a case filed to get a quadro, and it's only applicable to a qualified retirement plan. A qualified retirement plan is an employer-sponsored plan. So it is sponsored by the employer. I'm in Michigan. I see so many people with General Motors, Chrysler, Ford retirement accounts. So a 401k type plan, a 403b, it's the kind of a plan where you put money in as the employee. Sometimes you don't put any money in, and or the employer puts money in, and sometimes only the employee does. That money grows income tax deferred for retirement. If you take the money out early before age 59 and a half, you're going to pay a 10% penalty for early withdrawal, and any distribution is subject to ordinary income taxes. So let's think back to that pyramid I showed you before. If you take money out of a qualified retirement plan, that is treated as earned income added on to your earned income and will put you into the next tax bracket potentially, but it is added to your earned income. Now, as an employee, you usually don't have the option to take money out of your own qualified plan unless you leave your job. So again, the only way that you can get money out of a qualified plan when you get divorced is through a quadro. It does not matter what your judgment of divorce says. Your judgment of divorce is not going to get you that money. The only document that will get the money transferred to you is this qualified domestic relations order. And qualified domestic relations orders, or quadros, have some special rules that are attached to them, which you can take advantage of when you're getting divorced, that you can't take advantage of at any other time. So the rule that I'm talking about, it's IRS Regulation 72T2C. You don't need to remember that. It's in this presentation. So if you get a copy of this, you can have that written down. But what it does is IRS Regulation 72T says, 2T2C says that if you're getting money from your former spouse's qualified plan through a quadro, you have a one-time window of opportunity to take the money out and avoid the 10% penalty, even if you are not 59 and a half years old. Now you still pay ordinary income tax at your highest bracket. But let's go back to our earlier example of Kristen. She was in a really low bracket because her income right now in the early years after her divorce is just child support and spousal support. And that is not taxable income. So this might be a great year for her to take a distribution because she might be in a very low bracket and end up paying very little if she needs cash. So let's take a look at this example. $100,000 in Mike's 401k, $50,000 is awarded to Kathy. She needs to free up some cash to pay off her lawyer, to put a down payment on a new house. These are her options. One, she can roll it over to an IRA or into her existing 401k account. That's a completely tax-free event. Remember, any asset transferred between spouses is not a taxable event when they get divorced. Two, she can take a full distribution. She can take out that full $50,000 and say, I want that in cash. It's going to be subject to ordinary income taxes, but avoids the 10% penalty. She can also take a partial distribution and roll over the remaining amount to an IRA. Now, once she rolls over the entire thing into an IRA, she can't change her mind and say, oops, wait a minute, I forgot I need $10,000. She can take it out, but now it is going to be subject to that 10% penalty plus the ordinary income tax. So Kathy needs to make a decision about what she's going to do with her share of the money right at the time that that quadro is approved. So another option here, and this is just an explanation of that. So she ended up with $37,500 in cash, $50,000 distribution less 25% in taxes. She avoided the penalty, but her tax status this year, that entire amount of the distribution, the $50,000 that she took, that's going to be treated as taxable income on her taxes. Depending on what bracket she's in, that might be okay. She needs to evaluate that with the professional before she makes that decision. But you have to be aware of timing issues. So again, I have a collaborative case that I'm the financial neutral on. Both of the clients need cash. We brought this up as an idea on how they could get some, but they need it now. And you can assume that it's going to be 3 to 6 months after the quadro is entered before you actually see that money. So that's really important. I actually have a podcast episode specifically on the quadro process and understanding that. So a lot of people don't. So you have to be aware of timing issues. What are some other cash settlement options? You can take money out of a taxable brokerage account, like we were looking at that other example. It's typically a tax efficient way to do it. But again, as we discussed earlier, it might create capital gains taxes or force a client to sell something early that they wanted to hold on to for longer. Another option, if you need to free up cash, is a Roth IRA. All of the contributions always come out tax-free, even if it was your spouse's contributions, if that asset is transferred to you. And the withdrawals may be treated as tax-free as long as you do it a specific way. And again, that's where I would recommend that you get some tax advice. But let's be honest, a Roth IRA is the gold standard for financial planners. Not only does it grow income tax deferred, when you take the money out in retirement, the earnings are tax-free. Theoretically, you're in a higher bracket while you're working and a lower bracket when you're older, but still, if you have Roth IRAs in your portfolio, you want some of that money. I've had clients that say, well, you keep the Roth, I'll keep the regular. The Roth is worth more because it's not going to be taxable on the way out. So taking money out of a Roth IRA might not be the best place to free up cash because maybe that should be maintained for long-term growth for retirement. So then another way to free up cash that does not have any tax consequences would be a cash out refinance of your loan. Interest rates are really low right now, or I'm sorry, interest rates were really low. So most of the clients that I see, they have a really low rate that they do not want to refinance. Loan assumptions are very expensive. It's not a simple thing to say, I'm going to take on a loan assumption, and you won't know if you qualify for that until the divorce is actually final and you have the final decree. So if you're going to refinance and take out more money, you have to ask yourself, is the new payment going to be affordable to you? Which again, is why you really need to work with some professionals to analyze these things before you make a decision. But these decisions should be talked about and discussed while the divorce is being negotiated. Another quick option to get money is a loan against your own 401k. There's no tax due on a loan. It's very quick. Usually you can get that done. Not every employer allows it. So don't assume that your employer allows it unless you're positive they do. The maximum that you can take out is up to $50,000 or 50% of the account balance, whichever is less, but that is usually a quick option if there's cash needed between the clients. I will say as one other final tax tip before I open it up to any questions is that this is really scratching the surface of the tax information that you should have. Basic tax literacy is so important, and you should never feel like if you don't understand it that you are alone. Again, most Americans do not have basic tax literacy. If you're going through a divorce, which is a traumatic life transition, to throw that on top of it and be upset at yourself that you don't know this stuff, is that time well spent. So what you need to take away from this, what I hope that you take away, is that this is not brain surgery. You can figure it out. And with the help of an expert that can explain it to you and help you understand, along with you having some basic knowledge so that you can be your own advocate, that's the best way forward.
Awesome, Jackie. Thank you so much.
So I think we have one question.
Okay.
I don't see it in the chat, but somebody raised their hand.
Okay.
Oh
yeah.
So I'm gonna the person that raised their hand, I'm gonna unmute them so they can ask their question.
Perfect.
Okay, did you have a question?
Hey there. I was wondering how that was going to work. Yeah, so my question is a little bit specific to me.
Okay.
But so it's interesting you talk about the IRA and withdrawing the money. We are still in the process of moving forward. We actually have mediation in April. But I just received my spouse's W-2s and 1099s, and he withdrew over $20,000 from his IRA and did not withhold taxes. He also under withheld this last year on all of his taxes from his multiple
Wow.
jobs. My concern is it actually puts us in a very high liability if we file jointly right now.
Right.
And I am, if we file separately, I still get a refund even if I claim no children, and I let him claim all of them to reduce his tax liability. I'm trying to figure out potentially what is the best move here, and do I just file a extension until mediation and discuss it then?
Well, that is a great question. So I'm not an accountant, so I'm going to put that caveat out there that I can't give you specific tax advice. But again, I can give you general information based on my experience. I would first of all recommend that you talk with your attorney. That's number one. Number two, I would recommend that you think about filing an extension before you get this resolved in mediation. I would suggest that no matter how you end up filing, you need to figure out for sure with an accountant what is the best way for you to file. And we want to try to minimize the overall taxes due. But I'm assuming that you also want to make an argument that you shouldn't be responsible for some portion of the taxes on a withdrawal that you were unaware of.
Correct.
Do
I
you,
don't want this liability on the IRS docket for years to come that would affect me and my future returns,
right.
or potentially put my credit or tax liens or anything else, all these scary terms you hear about. I just feel very honestly, the tax liability is over 10 grand
Okay.
for this filing year.
And if you file married and separate?
The tax liability, if he claimed the children, is about 7,500. And if filing separate for me, there's zero liability and about a $200 return.
So if you can get him to agree to file joint and do you have assets that you can use jointly to pay off that amount? If it was 7,500?
Oh, I'm sorry. If he files separately, no kids, it's $12,000 liability to him. With the kids, it's 7,500. Joint is about 5,000 liability, and then yeah. Otherwise, it's a $6,700 to me if I
Right,
take all the
no,
kids.
right.
So it's a little bit of a tricky situation. Do we have any liquid? No, we
Okay.
don't, because uh, he has put himself in the poorhouse and is borrowing against things, and there are liens against properties that I was
Okay.
unaware of also.
So, I mean, I think that you're going to want to talk with your attorney about this, and you're going to certainly want to try to argue that you should be allowed to file married and separate, so that you don't have that tax liability personally, for this year. And I think that you need to kind of consider what you're going to do with the kids as far as who gets to claim them for, for future years. But you both have to agree, and that's part of the problem. Beyond that, and giving you more detailed advice about how you would go about filing without his agreement, that's something that again, you would need to talk with your attorney and with an accountant about. But I think you're on the right path. And it's a great thing that you know that you've got this information, that you know that he took out money and that he didn't withhold enough in taxes. A lot of people would go into mediation not knowing that. So that's great that you have that knowledge. And I think it's going to be a matter of you arguing that you shouldn't be responsible for part of that, and that the best way to make you not responsible is for you to be able to file married and separate. I'm not sure, did that answer your question?
It did, and actually it gave me a little more confidence to know that I am on the right path. And I wholeheartedly agree with you that married filing separate, even if I allow him to claim all the children, which, by the way, I have sole custody right now under the temp orders, and he has had no overnights since May. So I technically, according to IRS law, should be able to claim all the children.
Yeah, right.
But if I allow him to, as a
A
let me
concession on
file
your part.
separately.
I mean, it's a concession on your part too. I mean, I think that you're going into this assuming that the other side are tax experts. So I think,
Clearly he's not.
you could also argue that you want to keep the children. They're with you overnight, and by IRS regulations, that you are the custodial parent. So,
Correct.
I mean, I think those are all conversations to have with your attorney before mediation.
My attorney has been weary to offer a position on this, but think I'm going to write a very nice email laying out the scenarios and saying, I just want your support going into mediation, that this is what we're going for.
That's great. I love that language too. And I love that you're being your own advocate. That's amazing.
It's tough. I've come a long way. I've come a
It's
long way, and it's a
amazing.
long way to go.
I think I think that's amazing. And as far as, coming a long way with the taxes, that is absolutely not true. You know more than the vast majority of people. So,
Well, thank you. This was actually very educational for me. The Quadro thing was something I was unaware of. I didn't realize there was an IRS thing. The IRS that you can take it out, but it's going to be withheld at your income bracket.
yeah,
But you don't have to pay the penalty.
right. Yeah, it's a really awesome one-time opportunity that most people don't know about. So,
Yeah, I had no idea. So thank you for sharing that. This has been very educational. Thank you.
awesome. I think those are all the questions, Allison.
Awesome. Well, Jackie, I cannot thank you enough for pouring into us. I feel better. You've reduced my anxiety.
Oh, good. Good. That's my goal.
Yes, awesome. Well, thank you so much again. And guys, we will send out this recording if you need it. We'll send it to if you need a copy and want to go back and answer some questions. But Jackie, how can they contact you, or do you want to give your website or?
Yeah, absolutely. So you can contact me at www.roesslerdivorceconsulting.com. That's Roessler. I also have a podcast called the Divorce Rich Podcast that you can access anywhere you download podcasts. And that has my contact information on there as well. And I do want to thank Phoenix Financial Advocates for giving me this opportunity to speak to everyone about a topic that is near and dear to my heart.
Oh, I love it. I love that it's near and dear to your heart because it needs to help me. And thank you. It feels good to help people together, and I'll include all of that information in our messaging to pass out to everyone. So thank you so much, Jackie. And I hope we're all warm soon. Spring is here almost.
Bye, everyone.